All right, guys, we're going to get started in about 1 minute. If you have any questions at all as people are kind of logging on, there's a chat box off to the side. Just go and throw your questions in there. We're going to do a brief presentation on just what's going on with the market, what's going on with median home pricing, inflations, and all the things. But if you have any questions, again, just throw it in the chat box. What we will do is a quick presentation, then open it up for 30 minutes of questions and answers. Sorry if I'm a little congested today. Came down with a kid cold, and it is very enjoyable. So, all right. Well, it's 9:30, so we're gonna get going. I want to thank everyone for attending. We're gonna do our market update again. We're gonna be doing this just once a month. It's just a quick snapshot of what's going on. I think that's really important for investors to know what the activity is. Our brokerage at Heaton Real Estate sells a ton of property in King, Snohomish, Pierce County, so we got a very good gauge on what's going on with the market activity, buyer demand, and how things are selling right now. So, just about me, real quick, before we kind of dive in. I've been investing since 2006. We were active, myself and Will Heaton. We are active investors, buying a lot of fix and flip properties in 2008, 9, and 10. So we're used to kind of working within recession markets or any kind of transitional markets that there are. And we have flipped over 2,000. We've been involved in over 2,000 flip properties, whether it's with ourselves or our clients. And our brokerage has done over 3,500 transactions direct to investors, whether it's the acquisition or the disposition. And we've done over $1 billion in sales. We're very, very active investors in the local Seattle market. King, Snohomish, Pierce County, the Tri-County is our most active areas. Where our brokerage works. And so we're going to kind of look at those today specifically. Oh, sorry, guys. So the Tri-County overview. So King, Snohomish, and Pierce County, we're going to cover all those things. We're going to go over interest rates, what's going on with inflation, because that has to do a lot with the Fed rate and whether we're going to see rates fall or not. And then just different investment trends that we are doing right now. There is some very actually good buys in the market right now. We've actually acquired more rental property than we've done in the last year, in the last 90 days. So there's a lot of good buys out there. It's a matter of how you look at them, how you structure them, and we'll talk about that more in a second. So let's look at the Tri-County real quick. So I wanted to kind of highlight for the last couple presentations, we looked at the first half of the year versus the second half. And I think we all know that they're completely different, right? In the first half of the year, we saw rapid appreciation, days on markets under 5 days, multiple offers on almost every property. I think on average, we were selling properties 5 to 10% over list pretty consistently, especially in the beginning of that second quarter, the end of the first quarter. And then as the Fed increased rates, in the end of quarter two, the Fed started increasing rates very rapidly, the fastest we've ever seen in the history of increasing rates in that amount of time window. And what we saw in the third quarter was we saw a lot more impact with these rates getting increased dramatically. A lot of the rate increase was in that third quarter. And what we saw is a big value drop off that peak pricing. In March, February, March, we started seeing property, some neighborhoods appreciate at 10 to 20% in one specific month alone. And so that's where we've seen the compression back off those big peak values. Most of the drop came in quarter three and is starting to stabilize out. It definitely shocked the market when the rates were increasing that rapidly, and it slowed everything down. Average showings for the first half of the year, we were getting roughly about 10 to 20 showings a weekend. And then that slowed down to 2 during that time. So a huge drop off. That's about a 90% drop. And a lot of opportunistic buyers in quarter three came out. A lot of the offers that we were feeding were quite a bit under list without a whole lot of logic, and that's okay. Buyers can ask for whatever they want. And we started to see that kind of come out. That was the first time that we've experienced that low of offers in probably 36 months, where people were really coming in low. And then in quarter three, we were dealing with a lot on the acquisition sides, just some unrealistic sellers. As investors, we saw the market and felt the market come backwards because we're in a lot of short-term deals, whether it's development, fix and flip, or anything that you're buying and selling pretty rapidly. In addition to, we're looking at on buy and holds the rates and what you could actually cash flow the properties for. And so we could see the math in real time because we're constantly buying, whereas a lot of sellers were still kind of hanging on to the second quarter of the year. Transitioning to the fourth quarter, it has definitely slowed. It's gotten a lot more slow and steady at this point. We've kind of seen the compression down. It's kind of leveled out at a certain kind of price range for specific neighborhoods, and things are transacting now around those ranges. The percentage off list has been a lot smaller than we saw in the quarter three. Yeah, I mean, a good example is we just had a house. We had two houses go pending for right around list price. One was in Bothell. We had gone through a couple different sales. Kind of, we're definitely about 30% down from that peak value on that property, and then we are through the deal, and it was pending very close to list price. In addition to, we have another property in Redmond, same type of thing, where just was sitting there for a while. We kept marketing the property, and now we have two offers coming in. Uh, one is an opportunistic buyer, and one is someone that's a little bit more realistic on trying to get the transaction done. And so we are seeing more activity right now as the rates have somewhat leveled out. In quarter three, the rates kind of spiked up to where they were getting in the sevens, and now we're kind of they've kind of settled back down. The banks have stopped pricing in the increases as dramatically as they did in quarter three. So as the rates stabilize, the market will stabilize with it as well. We're still seeing a lot of opportunistic buyers. I just had someone offer 300 grand off list on a property. We just asked them to send us back comparables. They didn't have any, and we just kind of moved on at that point. One thing I have seen on the trend of these buyers is if they're writing the offer, they want the property. They just want to see what kind of deal they can get done. And so a lot of times their first offer is going to be about 10 to 20% below what they'll actually come to. And then you kind of try to have to meet in the middle at that point or move on to a different buyer. In quarter four, we have now been seeing better deal flow come through. Sellers, the media has kind of picked it up. Sellers are starting to realize they're not getting contacted as much. Properties for sale are getting low showings. And we can work a better deal right now or a safer deal into this market because the market's kind of dictating and educating sellers of what's going on. So I think it's really important to look at these two different quarters because we're starting to see the stability a little bit in the market. That doesn't mean things are going up or they're not somewhat still sliding backwards a little bit. It's just not as rapid as we saw in quarter three. So let's recap the Tri-County right now. So King County median home sales prices, we have ended at 1.3% up year over year. Now that is below the average normal appreciation for a year. Typically, it's about 3% on a, when you look at it on a 20-year basis, it goes back about, sorry, guys. Typically on a 20-year basis, the market average is about 3% appreciation. So we're at 1.3 right now. We were up into the 10% about quarter two. So we've seen this about 9 to 10% slide back off median home price in King County. Pierce County is now down 0.1% by the end of November, with the median home price now being at $595, down from $515. Snohomish County median home price is at $685, which is still up 5% year over year. So if you look at this graph real quick, guys, you can kind of see that the market was it kind of started ramping up, studied up, and then the FOMO kicked in, and then rates went. I think this is when the frenzy of real estate kicked in, was that end of 2021, and it just skyrocketed. And then what we're seeing is we're going to see a little slide back, and then it will steadily kind of level out at that point. So November recap specifically for each market. So Washington is up 1% year over year as of right now. So again, it slid back just like the rest of them. The number of homes sold fell by 44.5%, and the number of homes rose 145% year over year. Median home prices at $580,000. Days on market are up to 35 days statewide, and that's up 118.8%. And that's a 220% increase in supply year over year. Now, don't get too alarmed. Those are big numbers. Because the supply was so low for so many years, we're seeing, when you go from 2 to 8, it makes it a big difference. But technically, guys, we're still in a seller's market. There still is more buyers looking in the market than there are sellers of homes. What we are seeing is the people are being very selective, right? The cost of mortgage is very expensive right now for people. Pricing is expensive. And so people are being very cautious. They want to make sure they're buying the right house. They're being a little opportunistic. And so as investors, you just have to plan and build in longer hold times at this point. If transactions are falling by 50% roughly, that's okay, but you just have to wait for that sale, and we're seeing that in our listings right now. Uh, so current market conditions, King County. This is where we're gonna review the tri counties. So inventory is up 550% in King County right now. That's again pretty dramatic, but inventory was also below 2 weeks for nearly a year. So we're seeing a more healthy level of inventory in the market right now. It's not something that I'm too alarmed with. What I more want to look at is where's the stability in the rates, because inventory is still technically in a seller's market. There's still too few homes for sale than there is buyer demand. Again, it's just people are taking their time and people aren't moving. So, days on market have increased. And they're also the number of sales have decreased because people just want, they're not in a rush like they were 6 months ago. So inventory's up 550, but at that point, we're still like around 3 to 4 months of supply, which is still low for what's normal. Days on market are up 141% and averaging at 29 days. Percentage of list price is down. So on average in King County, properties are selling about 9.8% lower than list price. And we are seeing that kind of in our King County properties as well. People are just kind of throwing offers everywhere. And it really comes down to, are people doing concessions? Are they offering different types of financing? But we are seeing that 5 to 10% off original list price. Now, typically that original list price is still around what the normal performer was, which is on an elevated price. So sellers are still listing their homes higher. I think in King County alone, the average median list price is still 6% up year over year from where we were. And so the 10% off is really more of like a 4% drop, because the price started 6% above year over year anyways. And then 56% of all homes were sold under asking price in the last 30 days. So buyers are negotiating right now. They know they have a little bit of power, and people want to feel like they're getting a deal to pull the trigger on something right now. Oops. All right, Pierce County. So inventory is up 250% in Pierce County. Number of sales decreased. You guys, I really apologize. I'm gonna see if I can get a cough drop going at the same time. Number of sales decreased around 50%. Days on market were up 140%, averaging at 36 days. And original list price, they are selling for 5 to 9% under list. And those are kind of indicators of what the affordability factor is doing, right? Typically, King County usually stays a little bit stronger than Pierce County, but because the affordability factor and the cost of mortgage, we're seeing actually Pierce County selling a little bit more around list price. In addition to, like we talked about earlier, the average median price now is down 1%. So it's got a little bit further drop. We saw a bigger drop in quarter 3 in Pierce County than we did in King. And so as we're seeing that drop and getting more to the sweet spot, you can see the list price is selling a little bit closer at that point. And so what's happening is we're not going into a housing crisis. What we are going into is an affordability crisis where people are just getting stuck with what they can pay. And there's kind of a sweet spot right now. And then, as the rates have kind of settled down, the pricing settled down, the percentage off list is now smaller as well. I think Pierce County was around like 8 to 10% last month off list. So you're seeing that kind of slow down at that point. Snohomish County inventory is up 330%. Numbers of sales decreased 45%. So all 3 counties are around 45% in decreased sales. So don't be too concerned when you're selling a property. There's lower transactions right now. And so you have to either be patient or get in front of it at that point and really make it a good deal to get that to sell quickly. Not cutting price doesn't always move a house right now. cutting price might get you more showings, which you want to get to, but it's, just be patient. As the sales decrease and the days on market increase, you want to be patient. Look at your comparables. Are you priced correctly? If you are, just wait for that buyer at that point. And then percentage of list price, very similar to King County, was about 9% at this point. And so um, that what we're seeing is that kind of affordability factor is coming into play. With King County and Pierce County, the median home prices are around $700,000. So what that's saying is it's just not the upper end of the market is hard for people to afford right now. And a lot of the buyer pools in those two sectors are tech driven buyers, and right now tech buyers have gotten pretty hammered on their finances right now. They have layoffs that they're announcing, which doesn't seem as nearly as big as what the media is making it out to be. Their stocks have gone down since the peak of COVID, and the cost of mortgage has gone up by roughly 40%. And so what that's doing is causing that sector in the market to really just slow down and think about it, or wait until their stocks rebound or the money comes down. And because you have this patience on that specific buyer pool, you're seeing that sweet spot median home price, or the $700,000 to $900,000 range, is slow down at this point. Average showings on our listings right now, you guys, we have 19 actives and 16 pendings. That's about 45% pending. We've been staying pretty consistent with that since July. We've been on 45 to 55% pending at this point. Some of the ones that we have too are pre-sale, which are not moving that quickly right now. Average showings that we're seeing is 2 to 3 a week. That's pretty consistent. If we are not getting 2 to 3 showings a week, that's a concern for us. We start calling around, talking to the other brokers in the market. If we're down to like 0 to 1 or 1 to 2, we might want to look at adjusting price and kind of let that ride out. We're coming up into the holidays right now, so we're being pretty steady with price. But randomly, we wanted to get a lot of properties to market during this time, even though typically we wouldn't. The reason being is the rates have kind of fallen down. We're more concerned about the cost of money than we are the season. Now, this week going into the big holiday weekend, we're not really planning on listing a whole lot. But look, when you're putting your properties to list, don't wait for like the next season. Go if the rates are on a dip. Some investors, which I don't disagree with, they want to wait because they're listing some more expensive things, and so they want to go at the first year, which is probably a good idea. But if you have something that's a little bit more affordable at this point, I would say get it to market, because the rates have dipped backwards a little bit and they could pop back up. So you want to get those locked in buyers. Average days on market are trending at 45 days for our listing, so it's right around the same as what the median list prices are. A lot of times we are pricing brand new stuff and remodeled product, so it's going to be on the upper echelon of the pricing. And so we're usually a little bit of outside that median home price. So it makes sense that we're about 15 days longer than what a normal homes are selling at. And just like kind of the rest of the data, we are trending around 5% of list right now to get properties pending. So, oh man, got this cold. Take care of yourselves. I'm gonna go get a vitamin IV after this. All right, so inflation. You guys, and the reason I want to talk about this a little bit is this is the main driver of the Fed rates. There's two big concerns right now with the interest rates. Right, the Fed is trying to get employment in the labor market under control. We have way too few. Unemployment is way too low. And so by racking up these Fed rates, it's going to do more than just affect the housing. It's going to affect the economy in general. They're hoping to slow it all down. And that will increase unemployment numbers at that point. So if unemployment increases slightly and inflation continues to cool, that's where we're going to see, and we go into somewhat of a recession, you're going to see rates to start ease down. Basically, for what I'm seeing is the Fed's trying to get us into some sort of recession. Then typically with a recession, rates start to fall at that point. And so they're trying to get this market all leveled out from all the cash infusion from all the pandemic funding. Good news is October inflation rate came in at 7.7. November came in at 7.1. So it is starting to trend down. If you pull out the food and energy, which I don't really believe in personally, it's at 6.4. So it's still high. That's not great. It's actually not good at all, but it's showing the trend, and the trend is what we want to see, right? The more we watch these trends, the more we can forecast out. I know I was talking to a couple builders. A lot of guys are like, hey, I want to get some close and permit deals right now because they get long 12-month closes, and they think by the time they go to start building, they're going to be about 18 months out with finished product. They're pricing off of a higher rate right now. And so they feel good about their performance in 18 months because the pricing now should actually go up with the lower rates in 18 months as inflation goes down. So these are all really good signs that we're seeing. You just need to be patient. The market is braced. The market has braced for the Fed to end the rate hike in March at around 5.1%. So roughly the Fed is going to be around landing about 5 points to 5.25 by March, which is going to cause a little bit of issues for the first quarter of real estate for sure. We're still not done with the increases. Where we're going to see stability is when the Fed kind of slows down on these rate increases. And then also we want to see some stability in the Treasury rate, which we are seeing. So interest rate right now, it is affecting buyers by 40 to 50%, or actually about 30 to 40% right now on their monthly payment. The Fed's funds rate currently is at 4.25 to 4.5%. So we're looking at another half to maybe point increase from where we are at today. Today's current residential rates are 6.6%. So that is down from what we were seeing at the end of August. If I remember right, it was around 7%. And the 10-year treasury rate is at 3.57, which if you remember about 60 days ago, 60 days ago, it had gone above 4. That's not good. So we're seeing more stability as the Fed increases rates and things get a little bit twisted. It's causing the market to get stable. Stable is good. End of 2022 forecast, we got the final 0.25 to 0.75 right hike on the horizon. What a lot of people are predicting right now is that the rates are going to fall towards the end, and we'll talk about this actually in a second in the forecasting, but they're going to start falling in Q4. So we just got to kind of grind through these next 2 quarters. Unfortunately for me, I got a bunch of houses going live, but that's just the way it is. And but these first 1 to 2 quarters, you need to be patient, you need to price correctly, and then you need to really work with your broker team on getting that property sold with communication and feedback at that point. To show you the current math on display, it has improved since the last time we looked at this. On a $1 million purchase with 20% down in January, their payment would have been $35.64. Now it's at $51.92. On rental properties, this is 1 to 4. This is not correct, guys. I'm sorry. These are commercial rates. 1 to 4, you guys, is roughly about 7% to 7. It's about 7.5% right now. These rates at 4.25 and 5.42 or commercial rates were around 4.25 and now at 5.42 at this point. And so it's, and depending, you guys, and that has a lot of variance on what the product is. I don't know. Somehow I switched this. Now you guys get too much of me. Oops. I don't know where I just went. Well, I did something. Oh, well, you don't need to see my face anyways. And so what that does is that increase is at 4,000, and now it's at it gets up to 4,500. That's for commercial rates, and it really depends on the product you're getting. I mean, if it's interest only, if there's an ARM, there's so many different variables. A lot of stuff right now. If you're getting a larger commercial loan and you're getting it fixed for the first 5, you're typically going to be around that 6 to 6.5 range at that point. And so the money's kind of all over the place. It's really important, you guys, before you purchase a property, to communicate with your lenders, your hard money guys, your commercial financing guys, and your primary mortgage broker that you work with or bank, because that is swinging all different ways right now, and you want to know before you commit to a deal. Also, guys, one thing I want to say is price out and talk to as many mortgage people as you can that have different types of product. I know we had a client recently that was trying to get a refi done. He got rejected last minute, and then we got him over to a different mortgage company, and they're funding that deal today. And so just really reach out. If you're a client of us at Heaton Dainard, reach out to us. We'll get you a ton of different. We're working on building a bench of lenders for people. You just got to talk and price it out. You got to dial for dollars. What kind of money can you get? So impacts from rates, right? We've already know this. Market times are going to be longer. You got to be patient. Don't mix up patience with overpricing though. If your showings are really low, like 0 to 1 a week, you're probably overpriced at that point, and they're just looking. You want to be in that 2 to 4 range or even higher at that point. So stay on top of it. Talk to the brokers around there. Find out whether you're in line with the current market. Also, don't go off the median timelines. Go after your areas. Some areas are just taking longer to sell. Some price points are taking longer to sell. If you have a pre-sale townhome site, it's going to take longer to sell. And so just really look at that product, look at specifics, set your expectations, because if you know how long things are taking to sell, you can stay calm and get away from those irrational price drops. There's still selective buyers in the market right now, but I will say buyers want what they want. And if they really want a product and you have a good asset that you're putting up for sale, they will buy it. It's just going to take a little bit of time. You got to get that right buyer, but those are the ones that we're able to contract very close to list at this price at this point. Showings have reduced again 90% over the last 6 months compared to the first 6 months. All right. So our current strategy, now that we've kind of summed up the market, and you guys also, if you guys want to see more different type of information in here, definitely put it in the chat box and we can add more things in. Again, this is a kind of a short presentation, so we don't want to go too granular. But if you want me to throw in other kind of stats to talk about, by all means, throw it in the chat box. So what are we doing? So underwriting, we've increased our hold time expenses. As we saw, the median price is about 30 days to sell longer. So we're adding a month in our performance. We're still adding construction contingencies to all deals. We are using the cluster, the median comps, not those high comps. The high comps we are throwing out at this point. And then we're being very, very conservative on our values. The only time we'll be a little bit more aggressive if there's a lot of market activity. We were just looking at a property in Renton recently, and we looked at the 3 comps, and all 3 had been bid up in the last 30 days over list price. There was like a massive drop in this neighborhood, and then it just kind of got pushed back up. And so, we didn't go with the list prices. We went with the cluster because we had 3 of them, but it shows really good buyer activity and where that sweet spot is. Now I actually want more deals in that area because it's showing that the affordability of mortgage is good for that specific pocket. Recent sales, we're only using 30, 60-day sales and pendings. If the pending comps are much lower than the solds, then we're just going with those values. And then we've increased our margins from roughly 12 to 15% to 16 to 20% at that point. So we're adding more padding all the way through. I think most investors are talking about doing this right now. That is the way you mitigate risk, guys. It's up to you as an investor whether you want to be in this market or not. I can say there's good buys. We have bought a ton of property the last 90 days. But it works for us in our buy box. So really spend some time narrowing your buy box. And if you want to come in and meet with us, we can help you do that. And it really comes down to liquidity, location, and risk, and appetite for risk. And so we can kind of go all through those things and help get you narrowed in. So where are the opportunities at? We are seeing a lot of opportunity in the heavy fixers, right? The reason heavy fixers we're seeing even better deals is because the permitting sucks. It takes longer, and it's a lot of work, and you're exposed to a longer market. But again, like what I was talking about earlier, I'm actually starting to look at these deals a little bit more because there's some really good buys. And if I can get a longer closing with a seller, maybe release some earnest money to them or get a longer close and start working on that permits, it's just going to buy me time with no debt cost at that point, or buy it extra cheap to where I can stomach that debt cost. But the time I go to dispo, the market will be improved and rates should be below where they're at today. And so market is timing. Real estate is timing at this point. There's no way to hit that 100% on the head. We all did really well the first 2020, 21, or 21 and 22. The last half, not so much. We timed it well 12 months ago, not timing it well right now. That's just the way it goes, but you have to kind of consistently buy at this point. And so what we are doing is tracking those trends. When do we think rates will be low? When do we see market improving? When do we think we might come in out of a recession? That's going to dictate my buy box. Development I still love right now because dirt is cheap. I know we're looking at a fully permitted site in the east side right now, and it's 300 grand less than what people were paying um, 6 months ago, and it's fully permitted, not raw. And so there's some good opportunities out there right now for that product as well. Also, I like the development because not a lot of people are buying it. So that means there's going to be a low amount of inventory coming to market in about 12 to 18 months. And small, we're also seeing a lot of opportunities, small multifamily, right? Real estate is very trendy. So people are just going, hey, well, the rates are too high. You can't make it work. No, you can make it work. You just got to buy it right. And so don't get locked into just the rates. Look at what's going on, what's the pricing, and if it doesn't work with the rate, then offer what you can with the rate and see if you can get a transaction at that point. Um, so we have seen some pretty good buys on that. For us, finding those is just communicating, talking to a lot of people, and then we've definitely seen increased cap rates on large multifamily across the board. And this thing is stalled out. Sorry, guys. For some reason, it's not clicking over. There we go. So forecasting for 2023. This is just my own personal opinion, guys. Is I think we're gonna have a very slow first quarter. I know I don't. I do think the buyers in that market are going to be real buyers. They're seasonal buyers, and that doesn't mean that things won't transact. It's just you have to be patient. Market will start to normalize a little bit more in quarter two as rates normalize. That should be the last bit of the increases, hopefully. And rates will most likely drop um, to quarter four with the inflation, as long as the inflation and job reports come out the way the Fed's looking for it. And I know there's a lot of predictions that we're going to be like in the mid high fives by quarter four. So we would be down about a point from where we're at today. We are predicting that rents are going to flatten out. The luxury rentals might come down a little bit, but that bread and butter, 1,400 to 1,800, probably going to stay pretty firm. That's what we saw in 2008, 9, and 10 as well. And we do think there's going to be some really good buys on multifamilies and commercial spaces. Some people have bought some buildings on some short-term variable debt, and they're going to need to sell. So there could be some good opportunities coming up in the very, very near future. So if you are looking, get prepared with your liquidity. How can you guys forecast your investments a little bit? One thing that you guys want to realize is still a seller's market. So be patient. You're going to get lowball offers. If you want to take the lowball offer and get the deal off your plate, do that. And if you don't, be patient. But communicate with your broker teams and make sure that you're staying in the cluster of comps. You don't want to be that outlier house that's priced too heavy. Opportunities are definitely increasing, which is great. That's what we like. I like to buy more stable investments than what we saw the last 24 months. We talked about heavy fixers are going to be increased margins. Development is down 35% from peak. We kind of hit all these things. And that is going to conclude our presentation, guys. So for more information about the market, make sure you check out our Instagrams at Heaton Dainard and J Dane Flips. Or you guys, the best way for you to get good trends is to go to our On the Market podcast at Bigger Pockets. We brought on some really cool guests this last month in December. A couple of them blew my mind. That really opened my eyes about what I should be doing in 2023. So make sure you tune in, like, and subscribe. That Bigger Pockets podcast On the Market, and then also for more instructional videos, and we're going to be releasing a lot more forecasting videos on our YouTube channel, Project RE. So let's jump into the questions now, guys. I will stay on until everyone's questions are answered. Leon Massey, what's up, Leon? Are you seeing a lot of seller concessions right now? Yes, we are. Especially in the new construction space, builders are buying down people's rates. It kind of just depends on where you're at, but a lot of those are things that you might want to build into your pro forma If you're selling like first time home buyers, where they're helping with closing costs. I think on average, we were just talking about this yesterday, that there's a substantial amount of closing costs getting done right now. And so some of these markets that may seem like they've only dropped 3 to 4% are actually not factoring that in, and they're around a 10% drop. And so it does skew the data a little bit. Another question is, as a seller, should I look into doing seller financing since I'm not looking to pull out a chunk of cash now yet, but need some tax benefits? Yeah, that's not a bad route to go, guys. On the seller financing, you do need to own it outright, um, unless you're working kind of a more private sale. Um, it's, you can do some wraparound financing and kind of work with, if your loan's set up for it. The couple things you can do, the person could assume your loan. I don't personally like doing that all that much because I like to be in control of my own debt. And then you could do a carryback for a second position at that point. Um, but we are actually just listed a property for sale we're advertising it with a 4.5 to 5% rate right now. And it is getting our offers prices up about 200 grand or about 100 grand at this point. And so that's worth it to our client. They're fairly liquid, and they can wait for a year or two. And so they'd rather get the higher sale price and offer the financing at that point. But unfortunately, you got to be pretty flush with cash. And then the one thing I don't like is, it's gonna be hard for you to pull your cash out once that deal's done with owner financing. You're not gonna be able to do that. But it kind of depends on what the term is. When do you need your money? When do you want your money? And then if you can get it to a 1-year term, probably a good idea. 2-year term might be doable, but it really depends on what you need for your liquidity. Have you touched on new build material cost pricing levels and their changes? Oh yeah, that's a good question, you guys. I will put that in there. We can add that to the inflation section. We've seen building materials come back and pricing starting to come back right now. On average, we are getting a ton of subcontractors reaching out to us looking for work. Um, Actually, substantial amounts. People that wouldn't call us back for a year or two, or people I hadn't talked to in a year or two, now they're reaching out of nowhere. And now we're educating about what our budgets are. We tell them we need them to hit their budgets. They have to show up. If I'm really not interested in hiring people that can't budget and show up to work right now. I don't care what their pricing is. If you can't show up, I don't want you there. People not showing up definitely cost me some money at the end of Q2. And right now the name of the game is be efficient. Get things done in budget, on time, get it to market, because you can't let things draw out like we've seen the last 24 months, because that used to get a lot of appreciation, but now you're losing value. And you're increasing debt cost, and the debt cost won't keep up with the appreciation won't save the debt cost. We've seen at least, I know we've seen at least a 10% drop in construction costs. Materials are starting to come backwards. There's certain things that aren't, right. Like I know there's certain like HVAC stuff. Appliances are starting to get a little bit easier. As an investor, guys, you can save money in spots if you want to put in the work. I know a lot of places are starting to stock their flooring. We have to floor a 5,000 square foot apartment building. And we've been and the flooring's not coming up for about 60 days or so, maybe even 75. But we're calling through warehouses right now to see if they're oversupplied and they want to clear some stuff out. Because if we have the time, why wouldn't we try to save the money? If we save $1 on that, that's $5,000. And that just goes into the bottom line, or goes into other things that kind of came up. Another question is, between doing BRRRR or flip on a 2 to 10 unit small multifamily, which do you feel is a better investment for the first half of 2023? I think that really depends on, you guys, it's easy for people to want to go with a strategy that everyone wants to go with, or what, there is no right answer for that. It really depends on what you want to do as an investor and what you're trying to accomplish. Also, it depends on what your liquidity position is at the time. I would say the safer investment is going to be a buy and hold on a small multifamily, because you can run your numbers. You know what your return is. You can leave your cash for a certain amount of time. You want to fix your financing. I would say you want to look at the 2 to 4 a little differently than you would the 5 to 10, because that comes down to debt and financing. you're probably going to get a better deal on the 5 to 10 right now, because that's the mom and pop space that we've been seeing a little bit more opportunity. Um, if you're looking to buy one deal for the year, I would go with a hold. And I would look for something with some development upside because land values have fallen quite a bit. So you can go buy, for example, like maybe you can get a 5 unit on an LR site. That site's going to be valuable in the future in a good location because it's got townhome upside in it. But because of the financing right now, there's not a lot of demand if it needs work. And so typically when dirt was selling for such a premium, builders were going pretty heavy at that. But now they need long terms and long closes. So if you can come in with a quicker close, you can get some fairly good deals. In addition to, once rates fall, you're going to be able to take whatever cash flow you can and increase that in 12 months. So if you get a 6.5% rate right now on that building, or even if it's a 2 to 4, maybe or 7.5%, and rates do fall down to low sixes on the investment strategy, you're going to increase your return pretty dramatically. But that also doesn't mean that there's no deals in flips too. Like I think it comes down to what is your cash balance and is that good enough for you to just invest in, or do you need to grow that? For me, I'm always looking at, okay, here's the pot of cash I have. Here's my gunpowder. Is that doable for me to work with and get all my passive income out of it, plus some return with some other investments? Or do I want to get that bigger because, I run the math backwards. I need a certain amount of cash to pay me a certain amount of yield to get me comfortable in a passive lifestyle. So knowing that, that's going to dictate whether I flip things or keep them. But right now I'm doing both. We're keeping apartments and flipping properties. Any more questions, guys? And you guys, the market this is fairly normal. I know it shocked a lot of people. I mean, and it's not fun. Like Q3 sucked. Let's just be real about it. But it's, and unfortunately, some people have taken some major hits, including ourselves. Um, but we did really well for 24 months, like too well. And we just have to remember that and keep that in perspective. And now this is where the rubber meets the road. You can make really good money in this market and you can build really good wealth if you have your stuff tightened together. And if you're a newer investor, but you want to get involved, come see us at our investor 101 class. We had one last night. I had to cancel it just because of the snow. So we did it remote. We're doing them in person. Come meet with us. We'll talk to you about what we're doing and how you can kind of mitigate that risk at that point. And you're welcome, everyone. We're going to continue to do all this every month, just doing a check-in as we see some major shifts or positive things. We'll be talking about those things as well. And I just want to say good luck to everybody. Definitely reach out to us. Don't get caught up in all the headlines. Be cautious. Don't rush into a deal. Make sure it hits all your buy box. Spend some time really defining your buy box and what you can pull the trigger on. Like we know what rental properties I will buy. I know what fix and flip properties I'll buy. We know what development properties we're going to buy. And so as long as they hit those numbers, we're good to move forward. And so really spend some time defining that. If you're really, really concerned, guys, sit it out. And there's nothing wrong with that. But we definitely did well in 2008 to 2011 because people did sit it out. And it really allowed us to build up our processes, our business, and our holdings, which has changed everything for me over an 18-year period. So we're going to end it with this, and we will see you guys next time. Again, if you have not met us in person, come check us out. We will be doing, I think it's January 14th or second week of January, another Investor 101 Investor 101 class. And also, everyone have a happy holidays. Make sure you spend some time with your loved ones and enjoy the rest of the year.